Are gold and silver prices going to crash? It certainly feels that way. Why? Because the world's largest economy, the United States, wants gold and silver, and through them, all metal prices to fall. The reason is that its biggest competitor, China, wants the world to move away from a dollar-backed economy toward a metal-backed economy. This is because China has a monopoly over metals. China processes around 70% of the world's gold, silver, and copper. And when it comes to rare metals, about 90% of global processing is controlled by China. Now, what problem does this create for the U.S.? What is the foundation of U.S. economic supremacy? It rests on U.S. bonds, the U.S. equity market, and the liquidity or worldwide acceptability of the U.S. dollar. If large institutions or central banks of governments park their money in gold and silver, what impact will that have on the U.S.? Demand for U.S. bonds will fall, money will flow out of U.S. equity markets, and the supremacy of the dollar will weaken. That is why the U.S. wants metal prices to fall, and for this it has brought its tried and tested weapon into play: margin hikes. Earlier as well, in 1980 and 2011, the U.S. used margin hikes to bring down silver prices. The same tool has been used again over the past 3 days. On December 29th, the Chicago Mercantile Exchange increased margin requirements by 25%. Then again on December 31st, margin requirements on metals were increased further. On December 29th itself, silver prices fell by 12 to 15% within just 1 hour. Now there is a strong chance that the Chicago Mercantile Exchange will continue taking such actions until metal prices crash. So the current situation is this: China wants to challenge the supremacy of the U.S. dollar by controlling metals, and the U.S. will make every possible effort to ensure that this does not happen. So next time you look at gold and silver price charts, if you observe carefully, you will also see the economic war between the U.S. and China reflected in them,